Hi, everybody, and welcome to Chapter 3. Here we're going to be looking at job order costing as we started in Chapter 2 and look at the cost flows and external reporting associated with that. Okay, important vocabulary terms. There are 7 important vocabulary terms that were introduced in Chapter 2. The first one is job order costing, and that's a costing system that's used in situations where many different products, jobs, or services are produced each period. Absorption costing is a costing method that includes all manufacturing costs, direct material, direct labor, both variable and fixed manufacturing overhead in the cost of the product. The equation shows how to calculate the predetermined overhead rate. We take an allocation base, that's a measure of activities such as direct labor hours, machine hours, any logical allocation base may be used. And then we have predetermined overhead rate. Here, it's a rate used to charge manufacturing overhead costs to jobs that is established in advance of each period. It's an estimate. It is computed by using the following equation. We take the predetermined overhead rate, and that's going to be equal to the estimated manufacturing overhead cost divided by the estimated total amount of the allocation base. We had that in Chapter 2. Now, the equation for applying the overhead is also shown. Overhead application. Here, the process of assigning overhead costs to specific jobs uses the following formula. Overhead applied to a particular job is the predetermined overhead rate times the amount of the allocation base actual incurred by the job. So normal costing, that's going to be a costing system in which overhead costs are applied to a job by multiplying a predetermined overhead rate by the actual amount of the allocation base incurred by the job. And then the job cost sheet is a form that records those direct materials, direct labor, and manufacturing overhead charged to a job. Okay, that should have been a little bit of a review from Chapter 2. Now, our learning objective here is to understand the flow of costs in a job order costing system and prepare the appropriate journal entries to record those costs. And number 2 here, we're going to use T accounts to show the flow of costs in a job order costing system. So, more key definitions. Here are raw materials. Those include any materials that go into the final product. And work in process, that consists of the units of production that are only partially complete and will require further work before they're ready for sale to the customers. Finished goods consist of completed units that come out of work in process inventory that have not yet been sold to customers. And then what has been sold to customers, we show as cost of goods manufactured. Strike that. The cost of goods manufactured includes the manufacturing costs associated with the goods that were finished during the period. All right. Now, here's a diagram of how that all works. Here is the raw materials purchases, the direct labor, and manufacturing overhead. On the balance sheet, we'll see raw materials inventory that has not yet been moved into work in process inventory as raw materials inventory. Then the direct materials used in production will go directly to raw work in process inventory, and the indirect materials will go to the overhead pool. And then as we complete those goods, the goods that are completed in work in process inventory will show the cost of those goods that are completed as the cost of goods manufactured. Now, that gets transferred into finished goods inventory. And what happens next is one of two things happen. We either keep it in finished goods inventory or we sell it, and in which event that is reflected on the income statement as cost of goods sold as product costs. But we also have period costs here, right? These were the product costs, and these are the period costs. We have selling expenses and G&A expenses. Okay. Let's take a look at an example here. To illustrate the cost flows, this is a job order costing system. Ruger Corporation's transactions for the month of April. Ruger is a producer of gold and silver commemorative medallions, and it worked on only 2 jobs in April, Job Alpha, Job Bravo. A special minting of 1,000 gold medallions commemorating the invention of motion pictures was started during March and completed in April. As of March 31, Job Alpha had been assigned $30,000 in manufacturing costs, which corresponds with Ruger's work in process balance on April 1 of $30,000. Job Bravo is an order for 10,000 silver medallions commemorating the fall of the Berlin Wall, and it was started in April and was incomplete at the end of the month. Okay, so if we look at T accounts here, here's our raw materials. We debit raw materials inventory when we purchase that, and credit accounts payable usually to pay for it. Now, one of two things happens to that. Direct materials goes directly into the jobs. Indirect materials go into the indirect materials actual in manufacturing overhead. Again, that's going to be the debit side of manufacturing overhead. Okay. What we don't move into manufacturing overhead or work in process inventory stays in raw materials inventory on the balance sheet. Okay, now we purchase some raw materials in journal entry form. So here we're going to purchase on April 1, we had beginning raw materials of 7,000, and during the month we purchased an additional 60,000 in raw materials. There we go. And we purchase that in the normal way. Okay, pretty straightforward there. Now, during April, material requisition forms were prepared to withdraw $52,000 in raw materials from the storeroom. That's the raw materials storeroom for use in production. These raw materials included $50,000 of direct and $2,000 of indirect materials. So our journal entry is going to be, we're going to debit work in process inventory for $50,000. Those are the materials going directly to the jobs. And we're going to put indirect materials into manufacturing overhead of $2,000. And we pull it out of raw materials inventory with a credit. Okay, now, labor costs are recorded similarly. Here we have wages and salaries payable, or salaries and wages payable. The direct labor goes directly to the jobs. Indirect labor goes into manufacturing overhead. So that's pretty easy to understand. Now in April, employee time tickets which provide the hourly summaries of each employee's activities throughout the day, included 60,000 reported for direct labor and 15,000 for indirect labor. So we would record that in journal entry form with a debit to work in process, going directly to the jobs. The indirect labor is going to go into the overhead pool, and we credit the salaries and wages payable. Okay, now that's going to look like this so far, and we have some other overhead, which is considerable usually, and we're going to assume that they use these other overhead in this example here. Number 1, utilities, 21,000. Number 2, rent on the factory equipment, 16,000. Miscellaneous factory overhead costs, another 3,000. So again, we'll debit manufacturing overhead for the actual $40,000 and credit accounts payable to pay for that. Of course, we could always use cash if that's what we do. All right, but we almost always use accounts payable. All right, so now we've got all these costs in manufacturing overhead, and we're going to apply that overhead to jobs based on that predetermined overhead rate. So if actual and applied overhead are not equal, a year-end or month-end adjustment is required to bring to zero out this manufacturing overhead, as I explained in Chapter 2. Okay, so here we're going to assume that Ruger's Corporation's predetermined overhead rate is $6 per machine hour. And we're also going to assume that during April, 10,000 machine hours were worked on job Alpha and 5,000 were worked on job Bravo, for a total of 15,000 machine hours. Therefore, $90,000 in overhead cost, that's going to be $6 per machine hour times 15,000 machine hours, comes out exactly $90,000. And that's what we're going to apply to work in process. So the following entry is going to record how we do that. We're going to debit work in process inventory to increase it by $90,000, just like you would do here, right? And the credit is going to be to manufacturing overhead because we are taking it out of manufacturing overhead as applied overhead. Okay. So non-manufacturing costs are not assigned to individual jobs. Rather, they're expensed in the period in which they are incurred. So examples of that, number 1, we've got salaries expense of employees who work in marketing, selling, or administrative capacity, and they're expensed in the period incurred. And number 2, advertising expenses are expensed in the period incurred. So those are examples that are going to be expensed in the period, not in the product. And once again, if I look back at how we expense cost of goods sold, we're only going to reflect those product costs on the income statement when we actually sell that product. Right? So there may be a substantial delay in which the product costs are incurred to when they appear on the income statement. Okay, that looks like a good place for us to stop this video. And when we return, we'll take a look at these non-manufacturing costs in more depth. Until that time, bye for now.